Okay, we're going to start over. So good morning again, everyone, and thanks for joining us. This is our last small business seminar of 2022. It's actually our last event of 2022. So we're excited to have you here today and to learn more about income tax updates and strategies to reduce your taxes in the new year. So this is a hybrid event. We have some of our members in the chamber conference room and others are here on Zoom. We will have plenty of time for questions at the end of the program, so you can either type them in the chat or you can save them until later in the event. So now it is my pleasure to introduce our speaker for today's event. Barry Fields has over 20 years experience in tax consulting and auditing in public accounting and private industry. Barry is a partner with Bormel, Grice Huyett, where he has worked for over 13 years. Barry is very active at the Chamber, serving as a co-chair of our Small Business Committee, and he also serves on our Board of Directors. So I'll turn it over to you, Barry.
Thank you, Christy. Good morning. Thank you, everyone. Thank you for being here, and thank you for being there. Looking forward to that. I do this every year. I guess the pressure's on, knowing it's the last event of the Chamber, so we got to make it a good one. Last one of the year. No, but we're here today for a combination tax update / tax planning. And they kind of go hand in hand. But first, what I like to do is give a little bit of an update. Anyone who's been here before, I've been doing this for a few years. You should have gotten, if you're on Zoom, you should have gotten an email yesterday. Attached to it is the material, is the handout. We're not going to put that up on screen because of the hybrid nature. It's already more difficult. So hopefully you have access to that. It's a 5-page handout. I do not have enough time to go through bullet by bullet every bullet. I will cover a bunch of them, most of them. We'll talk about what I've gotten to determine is the important stuff today. The handout is twofold. You've probably heard this before if you've been here before. One, it's a good resource to refer to. The other one is I highly recommend if you're having any trouble sleeping, leaving it on your nightstand or something at home, and you refer to it at some point, then you may not even get to page 3. So also, if you've been here before, I want to apologize for some of the rehashing of the jokes. There's only so much a tax accountant has in their warehouse as compared to a stand-up comedian. So I got to just make the best of what I got as a tax accountant. So here we go. Also, if anybody has any questions, I'm going to request if you can please, if it's directly related to something I said, because I'm not sure of what I said, confused, didn't understand, didn't hear, by all means, whether you're here, please, speak up or type it in. And if it's otherwise off topic, if you could save it to the end. We have about an hour. I will try to go for about 45, 50 minutes. I have a clock here to try to keep myself on pace. And I'll save some time for the end for questions. But by all means, if it's something I said that really, to clarify exactly that, by all means, jump in and ask the question. Like I said, I'm not going to go, so starting on page 1 at the top of the handout, this is where it all started. A couple of years ago, the Tax Cut and Job Act, that was the 2017, otherwise we call them the Trump tax cuts, is if more familiar words. The way the handout is written, I want to just backtrack a moment, is the way the code, a lot of rules are expiring these days. They have, if you follow the news, in order to get tax cuts or tax increases or tax decreases and spending increases and spending decreases through Congress, since no one plays nicely, both parties need to agree. That's basic. The House and the Senate have to both agree on something, and then the president signs it. That goes back to probably elementary school or middle school government. Unless one party completely controls the House, Congress rather, and the president, then when they agree, then it's kind of what we say forced through, for lack of a better term. And it's usually on a 10-year plan. It's called budget reconciliation. That's what we've been hearing a lot of lately. So going back very quickly, if people remember under President Bush in the early 2000s, there was what we call the Bush tax cuts. They were on a 10-year horizon because it went through this thing called reconciliation. One party, quote unquote, pushed it through. The other party said, you can't force that on everybody. That was in 2000-ish. Then with President Obama, the Affordable Care Act came in. That also had some tax cuts. Again, one party said, you can't force that on us. The other party did it. Then we have the President Trump, the Tax Cuts and Job Act, which the Republicans, which one party pushed through. The other party said, you can't push that on us. And then now we most recently had the Inflation Reduction Act, where one party pushed through and the other party said, you can't push all that on us. So there's a pattern here.
Yeah.
And most of these larger tax bills, whether they're spending increases or decreases, revenue increases or decreases, are only good for 10 years, and we'll talk about that, and then they expire. That's important because it's important in what we're talking about today, because it leads to a lot of the confusion and uncertainty for business and personal tax planning, because something today is going to expire in a couple of years, but they got this new thing that's good for 10 more years. And in between the years when one party doesn't have both houses and the presidency, there's also, they compromise and bipartisanship comes through. And those changes tend to be more permanent because they don't have to force it through this reconciliation process. And so they're more permanent. And sometimes some of these temporary 10-year plans, pieces of them become permanent. So I bring all that up because it kind of affects my outline and how the timeline of it is, because the first page covers the Tax Cuts and Jobs Act, which I can't believe I'm about to say only has 3 years to go on the individual before that 10-year window. In that one, a lot of the individual provisions were temporary. A lot of the business provisions were permanent. We'll talk about that as we go. Then that was the first 2 pages. The third page is the Secure Act, setting every community up for retirement enhancement act. I can't memorize all this, the Secure Act. And that one, lo and behold, there's a lot of bipartisanship. That one's not going to expire. Those are rules. We're good to go on that one. Then we get into page 4, the Inflation Reduction Act, most recently over the summer. I'm purposely talking a little quick to get through some of this. I'll slow down when it gets to be actually important. The Inflation Reduction Act, that one expires again. So I was originally going to start from scratch, and the last page is some miscellaneous topics, which is probably the most important page. I started to try to put this in some sort of like individuals first, then business, but I kept it as a timeline, so people could refer to it again, because things will start dropping off. It's kind of, again, like makes tax planning very hard. What did drop off, if you had this from last year, is for the last 2 years we had a lot of corona relief efforts, and a lot of those have fully expired. You could still amend a tax return if it's 2022, and if you learn something today, well, not now, in general, that would have changed your tax picture in 2021, you could still amend those returns, but most of those rules have passed. But the benefits are out there for that year if you need to amend a tax return, such as like the employee retention credit, that's still out there, but the ability to get it now is over for 2022, going into 2023 rather. So I left the timeline, but I took off things that are not relevant. So starting at the top, we're not going to go through everything. The first section, the very first piece, is just talking about the Tax Cuts and Jobs Act. The big talk then was the big push was lowering tax rates, simultaneously eliminating a lot of deductions or changing deductions. So that the overall idea was people would pay less taxes. It would hopefully be less complicated because more people on the individual side would take the standard deduction rather than itemized, pay lower. You would lose deductions, but pay lower taxes. Some people said it worked. Some people said it didn't work. That's not my job to talk about today. I'm just talking about the tax law. One of the reasons I like to give the tax brackets, these right here, these are the tax rates. They broke them down. It was like 8. It used to be 8 or 9 tax brackets. They reduced it to, I think, 7. Somehow someone said that makes it more simple. I don't know how, that made that work, but whatever. So we have our tax brackets, and these are set to, we have 3 more years, 2023, 2024, 2025, and then we're going to go back to the older brackets, the prior, unless something is changing. And the important part, one of the reasons I put the inflation adjusted numbers in here for 22 and 2023 is for 2023, there's a significant jump. It's in a lot of the inflation adjusted numbers. Because of the inflation we're feeling now, the inflation adjusted numbers have increased more than traditionally over the years. So for example, the 24% tax bracket, a lot of people fall into the 22 and 24% bracket. If you're married filing joint, 24% goes from 178,000 in 2022 to 190,000 in 2023. That's the top end. If you're making that amount or lower, the brackets are, the U.S. tax code is brackets. You start at 0% and you go through each bracket. So if you're in the 24% bracket, that doesn't mean all your income is taxed at 24%. It means you've made enough in each bracket first. There's a 0% layer, then a 10% layer, a 12. You've worked your way through it. And so your last dollar to be earned would be in that bracket until you get to the next bracket. But if you see how it jumps for married filing joint, it goes from 178 to 190 in 2023 and 89 to 95 for singles. And that alone, if your tax picture, if your income picture is exactly the same in 2022 as it is in 2023, your taxes will go down just from that spread right there. And the purpose for that is because your spending on other things probably went up due to the inflationary era we're in right now. So just trying to keep track of that. So that's the tax bracket. You're gonna prepare your return. The professional's gonna prepare your return. You're gonna work through the numbers, income less deductions gets to something called taxable income, and then your taxable income is when the brackets come into play. That's on the income side. Individuals either take the standard deduction or they itemize. And the Tax Cuts and Jobs Act changed that significantly as well. In the individual itemized standard deduction, it went from 63 for single, 6,300. It's the first sentence of the second bullet. The brackets were 6,300 and 12,700. Those were the amounts if you're single or married filing joint. And for 2022, the amount we're passing right now, it's more than it. Just bear with me. I don't have these memorized. It's now 12,900 in 2022 for a single, and 25,900, 27,700 rather, if you're a married filing joint. Those are big jumps where it was to what it is now, and that was the idea. That was the government, the Congress, and the president. They increased the standard deduction significantly so that you would pay less in tax, and by doing that, they also eliminated or reduced some of the tax breaks. So, for example, if you're itemizing, meaning you're not taking the standard deduction, you're going to itemize. You're going to take one of what I call the big three. You're going to take all of. You're going to pay state and local income taxes. You're going to pay mortgage interest if you own your own home, and if you make any charitable contributions. Those three, I'll say that again, your state and local taxes, your mortgage interest if you have one, and your charitable contributions if you have any. Those combined would need to be greater than the standard deduction to then take the standard deduction. Otherwise, to then itemize. Otherwise, you would be better off from a federal tax perspective to take the standard deduction. And so, that's why I call those the big three, because without one of them, you may not get there. The Tax Cuts and Jobs Act changed the state and local tax for everybody. So the first slice, especially in this area, we see that most folks are already paying paying at least $10,000. That's the ceiling, $10,000 on state and local taxes. If you own your own home, it includes your real estate taxes plus your income taxes. If you own your own home and you're married and both you and your spouse work, you're probably definitely over the 10,000 limit, and everything over 10 you don't get to deduct on your tax return, so you get that 10,000 ceiling. So if in 2022 the individual if the itemized deduction ceiling, floor rather, is $25,900, we just talked about 10,000. You need 15,009 more in order to itemize or to benefit from the itemized deduction for federal taxes. And so that 15,900 you're going to most likely get from mortgage interest if you own your own home, and charitable contributions. And that's a pretty high number in those two pieces to get there. So that was the idea of doing this, was more and more people are taking the standard deduction, which overall does lead to some tax simplicity also. That was part of it. And less shenanigans, less wiggle room for people to play with. And so the 15,900, then there are limits within those also. So we had the $10,000 state and local taxes, the mortgage interest deduction, which used to be based on a mortgage of up to $1 million on your personal residence and a second home. This same tax cut that in 2017 made that ceiling $750,000. If you owned a home with a mortgage prior to December 15th, 2017, then you're grandfathered in at that million ceiling I talked about a moment ago. But any home bought after December 15th, 2017, you're capped at $750,000. The mortgage interest on a loan, not $750,000 of interest, but the mortgage interest on a loan of up to $750,000 on your primary residence and a second house. It's not $750,000 per home. It's combined. And if you refinance an older mortgage that's been grandfathered, then you still have that higher ceiling refinancings count. Um, Another thing that had changed was the old home equity lines of credit. If you had a line of credit secured by your home, you were able to you were allowed to deduct the interest on up to $100,000, regardless of what you did with that money. You had a home equity line of credit. Originally, the idea was a lot of people do home improvements, but you could have done anything with that money. You could have paid. Unfortunately, you might have had medical costs, college education for somebody. The new rules eliminated all these other. It has to be for a line of credit. The home has to be securing the line, and the cost must be to improve the home. And so and it wasn't grandfathered in. If you capped out your $100,000 line of credit for something that wasn't for home improvements, that is no longer deductible under these new rules. So that was one of the limitations, which on one hand sounds painful. We lost deductions, but let's go back to the itemized the standard deduction ceiling going into this year is now $25,900. Many people wouldn't even get there to 25,900 with all the interest. So it was a balancing act. And then the third one is charitable contributions. Those rules have fluctuated over the last few years. You can deduct up to 50%. If you make a cash contribution, a lot of people don't do the maximum, but you can deduct up to 50% of what's called your adjusted gross income of cash contributions to a charity and receive that deduction. And again, when we talked about before, we're at 15.9 to get to the ceiling, 10,000 of state and local taxes, another 15.9. Most people need to contribute a lot of money in order to itemize. So when we talk about tax planning, bringing that in a little bit, people say, one of the overarching ideas of tax planning, generally you need to spend money to save taxes. So one of the ways to save taxes is to make very large charitable contributions, but that's going to cost you cash. So everyone gets to balance they have to balance their cash needs. Cash is king. So you need to balance your cash needs from your willingness to pay tax. For every dollar you spend that's a deduction, you're not getting a dollar less in tax. That's called the tax credit. But a deduction will be a reduction of when we go back to these rates above. You take your income, less your deductions, apply these rates in the first section. And so, for example, someone who's paying 24, it's not quite this clean, but if you're paying 24, if you're in a 24% tax bracket for federal taxes, plus state taxes gets you close to 33 or so. For every dollar you spend, you're saving 33% or so in tax. You have to decide if you want to spend the other 67%, the other 67 cents, or keep it. And you're still going to, because again, it goes back to the 25.9 for itemized as the ceiling. So it's a tough burden to get through. Every year it goes up. And by the way, 25.9 is for married filing joint is the standard deduction in 2022. It jumps to 27.7 in 2023. That's a big number. So and that's again the inflation adjusted number. So, and that's what I just covered with what I call the big three: state and local taxes, mortgage interest, and charitable. That's open generally for everybody. The fourth one, which we see less and less of, is itemized deduction for medical bills. That one jumped around a lot. It is now permanent at 7.5% of AGI, meaning someone whose gross income, their wages, interest, dividends, etc., self-employment income, if your AGI, if your adjusted gross income is $100,000, you need medical expenses in excess of 7.5% of that, 7,500, in order to deduct the first dollar of medical expenses. So if you have 8,000 in medical expenses, in my example, you would only deduct 500. You're not going to deduct the first 7.5%. You're going to deduct the excess of that. I left the bullet on below regarding the child tax credit. That's been jumping around. The old rules was $1,000. This Tax Cuts and Jobs Act made it $2,000. Kids under, I'm not getting into all the fine print of the kids, but if you have kids under 17 and younger, you get a $2,000 credit. That went up to $3,000 in 2021. If you had kids, I think it was 6 and younger, it went up to $3,600 in 2021. Last year, we had the advanced tax credit for children. The IRS was giving out checks of 50% of that amount. If you received those credits last year, the $3,600 or the $3,000, and it's back down to $2,000 in 2022. I always like to use, so if you're in the exact situation, your income, your deductions, everything is exactly the same as last year or this year, and you have kids that qualified for the $3,000 deduction credit last year, you're losing $1,000 this year. you never had it. I don't want to say you're losing it. It went from 2 to 3, and now it's back down to 2. So just be aware of that when you're doing your taxes. When you come up with, oh, I owe more, then my refund went down compared to last year. A lot of it's going to be this one right here. What was a $3,000 or even a $3,600 credit a year ago is now $2,000. And that's the old rule. And then again in 2020, at the end of 2025, that'll go down again to $1,000. I left a spattering of things on here. I'm going to go the credits for dependent care, the credits for adoptions, 529 plan. Those were all these have been around for a couple of years now, and generally these all expire at the end of 2025, 3 more years, and it goes back to the prior years. We're now going to move on to business taxes changes. And again, this is from the 2017 tax cut. The corporate tax rate, we don't see this one a lot, especially in this kind of setting right now. This is for C corporations, whether you're a small C corporation or upward to Microsoft and et cetera. Their tax rates are now 21%, a flat tax of 21%. It was 35%. There were a couple of buckets to get there, but it got pretty high for the corporate tax rate to get, it was pretty low rather, to get to the 35% rate. That went from 35 to 21. The idea was as a global economy and competing on a global scale, that the U.S. corporate tax rate was much higher than other countries, so they brought that down to 21%, and that is permanent. That will not go back up unless it will take an act of Congress to go back up. Most of what I'm about to describe is permanent, except for the next one right now. Folks said, okay, you're lowering the corporate tax rate, but what about all the pass-throughs? What about self-employed people who file what's called Schedule C? It's just an income statement that's included with your tax return. Or you're a partner in a partnership, you get a K1. You're a shareholder in S corporation, you get an S corporate tax return K1. Those are not corporate entities per se, a C corporation, so they pay rates. That income passes through to an individual, and so what happens at the individual? They came up with a qualified business income deduction. Very complicated. We're not going to go through it today. There is some information on our website if you're interested. In a nutshell, it's a 20% deduction with limitations, of course, because what's in the IRS tax code without limitations and what ifs. But it's a 20% deduction for either self-employed income, pass-through income, business income that is taxed on an individual return. It's a 20% deduction. And the idea of it was to bring the effective tax rate of the business income to about 30%. It's more than the 21, but if you're in the higher income brackets, your business income has the tax on your business income has come down. But then there are also, if you're in the higher tax brackets, there are limitations for that, which is going beyond a little bit of what we're talking about today. That's the 20% qualified business income deduction. The tax cuts also increase significantly the immediate write-off for improvements for fixed assets, equipment, computers, office furniture, office equipment, anything you need, what we call personal property. The amount you can write off immediately is up to now. It's the original. This rule was written at 1 million, but adjusted for inflation, I believe it's $1,080,000. If you're filing a corporate return, your business return, you can take what's called 179. You're not going to take $1 million unless you have high income. You can't just take $1 million. First of all, you have to spend that. So I'm not sure how many people on this call today are at that ceiling. And you also can't take a loss for that. If your income is 500,000 before this, and you're not going to have a loss of 500,000 after. You're going to be capped at 0. You're going to get it to 0 and have a carry forward. But you have up to that. So as long as you have business income and you have improved, you bought equipment, for your business, you get to write it off, but just not to a loss, and you take it and you can deduct the carryover next year. Maryland did not change that. That $1 million limit is $25,000 for Maryland. So you would have 2 separate depreciation schedules tracking the different depreciation. Also, the rules, there's something called bonus depreciation, which is another form of accelerated depreciation. For years, we've been talking about it, 100% bonus. That's been out there for a number of years. You buy generally the same equipment, same items for your business, you get a 100% deduction. That is finally hitting the end of its life, and it's going to start phasing down over the next few years. So in 2023, that what you call bonus depreciation is now 80%, 80, 60, 40, 20, then 0 in 2026. These would have been expired a few years ago, but Congress keeps pushing that one out. So not sure if they'll, at some point, maybe they'll extend it again, maybe they won't. And that one, if you have a loss, you can take a loss for that. You can, if you had, some income and then you take this bonus depreciation, it causes a business loss, you would have a business loss. And again, the Maryland does not, or most states don't follow that. So again, you would have a federal and a state depreciation schedules to track the difference.
There's a question in
Please,
the chat
thank
from
you.
Matt. Does the 20% business income deduction apply to earnings that must be declared from side hustles?
Depends on what you're calling your side hustle. Yeah, pretty much, you declare it, it sounds like you would file a Schedule C. Your side hustle is a legal activity, and you're reporting the income, you're reporting the allowable deductions, and as long as the rules apply, as long as depending on your income limits, et cetera, you would get a 20% deduction of that. The answer is yes. But then there are the normal limitations. If you're, for example, for higher income folks, business consulting, the services, a lot of the service industries don't get this deduction at higher income limits. Accountants don't get it, lawyers don't get it. I guess engineers and architects had friends. I think the idea was to build things, they designed it. So engineers and architects would get this credit at higher income limits. So if your side hustle is services, and you're under the income limits, you would still get it. If your side hustle is services at the higher income limits, then probably not, meeting the limitations. I hope I answered the question. Also going through here a little bit, there are limitations. We talked about bonus and 179 and these large write-offs for cars, SUVs, pickup trucks. If the vehicle is what's otherwise used as what they call a passenger vehicle, there are limitations. The logic being that the American citizenry isn't necessarily buying cars for everybody and paying for the cars. There are limitations. If you have a van used for work, 100% for work, it's delivering, it's got the name of the business on the side. It's not a passenger van for you to drive to and from work every day, but it's literally a work vehicle. That's a different category. That would be regular depreciation rules, 100% depreciation. But a doctor buying an Escalade to get to and from work, an accountant, buying a Lexus, getting to and from work. There are limitations. The business use is limited and the business deduction is limited. So just want to let people know the difference on that one. Also, there's a business interest deduction if you're taking large mortgages. Large lines of credit to purchase some of the fixed assets, et cetera. The amount of your interest to be deducted is limited to 30% of your income. The idea there was they didn't want folks letting the tax deductions and the tax rules to, I was about to use the word Trump, not big, but it was actually part of the Trump tax cuts. It was actually his idea. It was his idea. It was his thoughts. The idea was you're going to finance things 100%, take these large loans that you could barely afford to get these large tax write-offs. It didn't make good business sense. It was one thing if it was, and that the tax deduction, the tax interest deduction shouldn't be the overriding reason why you're doing something. And so they limited that to 30% of the income. So I'm going to move on a little bit and try to get into more of this. But for the most part, everything I just described for the businesses is permanent, except the 20% deduction. Everything I said for individuals will expire at the end of 2025. One important thing, and it's part of this, but it's gone up, it's gone down. These rules significantly changed what's called the meals and entertainment deduction. The deduction for meals and entertainment has changed drastically. A lot of people probably still have it in their general ledger. I'm talking about businesses. A lot of people still have a category, an account called meals and entertainment. You probably want to change that to meals. Entertainment is no longer deductible at all. If you take someone to a baseball game and you buy the ticket to the O's game, the tickets are not deductible. If you take someone to a show, to a golf, to play golf for the day, the cost associated with that entertainment side is not deductible at all. The cost for the meal is deductible. The rules were, and through 2022, there's a little bit of a twist to it, so I'll explain that. The rules were, it's a 50% deduction. If I take somebody out for lunch, we talk about business, there has to be a business purpose. It doesn't have to be business purpose is very broad. It can be talking about referral possibilities, working together possibilities. It could be a current client relationships. The client can take you out, whatever the reason being. There needs to be a business purpose. And if so, you're allowed a 50% meal deduction. And I don't know if this is really, I like to explain it. I don't know if this is truly why, but I like to explain it that my meal, if I'm taking you out, my meal is not deductible. I'm going to eat no matter what, whether I have lunch alone with you or somebody else, I'm going to eat no matter what. It's not deductible. The business side is me taking you out. That's the half. I'm not sure if that's exactly the right logic of how it got there, but it's a good way to, it's a simple way to explain it. So 50% deduction for meals. As a corona relief change for 2021, which is behind us, but we're still in 2022. So look back in your receipts and whatnot, and you still have a couple more weeks. Meals from a restaurant, not convenience stores. Meals, you don't have to eat in the restaurant. You can take it out. With all the hits that the restaurants took, meals, business meals are 100% deductible in 2022. It was for 2021 and 2022. Obviously, 2021 is behind us. So for 2022, you're allowed a 100% deduction for meals. That was to try to help the restaurants. It could be takeout, it could be curbside pickup, obviously the same thing, or in the restaurant, most likely. We have a question here. Yes.
Yeah, so I know. So
We're just trying to
through hybrid and in person, right? So would this include purchasing staff lunch?
That's a little bit of a different category.
Okay.
That one is sort of for the benefit of the employee, and that one is deductible, and that's not necessarily a meals taking a client out.
Okay. So the change for 2022 would be meals, restaurant-based meals for clients.
Correct, and that's not necessarily the change. It's a different category of meals.
sense.
That one's not just 2022, but yes. Staff work in-house. It's for the benefit of the employer. It's a fringe benefit. You're not doing it every day. You're not providing, it's because it's like I said, there's
Like we're on a big project and it's bad weather outside. So like we prefer just bring lunch in for everyone. So people don't have to go out and deal with the bad weather and the time of stepping away in bad weather and what that could mean for work product.
No, I understand. Yeah, there are rules that falls into the fringe benefit rules. And I don't want to sit here with a blanket yes saying all meals you bring in is always deductible in-house, but in the right situation, the answer, without being abused, the answer to that is yes.
Can you repeat what Christy's question was? They're not able to hear the question.
Christy asked if bringing meals in-house is deductible, and as opposed to a client going out meal. And the answer I said was within certain situations, within the right framework of part of employee fringe benefits and employee benefits, the answer is yes. It's not. There are 8 of us in this office right now. In here, there are 7 of us, and say we're just one office. The 7 of us, only 2 of us are having a meeting, and we're going to bring in lunch for the 2 of us. It starts getting a little dicey and abusive. I would not. It's more of a team. Things for everybody, open for everybody. It's not just the owner's lunch, etc. As long as you sort of fall within the rules, then the answer would be those meals would be deductible.
Okay, we have, since we have a small pause, David has a question. David, do you want to unmute and ask?
Yeah, thank you. Can we flip an entertainment expense into a gift expense?
Probably most likely not, because generally in business, the IRS would take the position there's no such thing as a gift in business, because you are doing what you're doing ultimately for the business. The idea of a gift, you're giving something to someone with absolutely nothing in return, the expectation of nothing in return. In the business world, I'm not going to say that's always the case, but if you step back and look at it, if I'm taking someone out for lunch or if I'm taking someone out for entertainment, and the whole purpose of that is because of our business relationship, I'm not expecting nothing in return. That person's not expecting nothing in return. That is the strict way the IRS would look at that. I'm not saying here that that's absolutely never the case, but as trying to give you some information. That would be the most likely the IRS's perspective, is that in almost all business relationships, there is no gifting. I believe there's a de minimis. You can give clients up to $25 for, you close a deal and you give them a $25 trinket. That's different. That's different than taking them out for $25. So that, hopefully I answered your question.
One more question from the chat. Actually, two.
I'm gonna, are they direct, if, on the meals and entertainment side, we could probably go for 3 hours, and still not answer every question. This is pretty,
You wanna hold these till the end?
yeah, let's hold these to the
All
end.
right, we'll circle back, Scott and Christie.
Yeah, and I'll make sure there's time later, otherwise separately. One thing I do want to say also though is on the entertainment side is if your meals and entertainment, if you're taking someone to, like, for a skybox, for example, you go to the skybox, you rent out the skybox, it comes with food. As long as there are separate invoicings or even tickets, the tickets to the game are not deductible, but the food is. So if you're using a skybox or some other means, using that as an example, if you get an invoice that breaks out the food from the entertainment portion, the food portion is deductible. And again, it has to be at a restaurant. So this example would be 50% again. If you go to the game and you know, a place that normally serves food for the purpose of, at a restaurant as opposed to at a game. Games would be 50% when it's part of an entertainment piece, where the restaurants would be 50%, 100% rather, through 2022.
Could it be could it be a marketing expense?
No, it would still be food. I mean, it's what you want to call it. This is why I'm trying to move on from it. There's a lot of vague areas. At the end of the day, the food is the food. There are specific carve-out rules of what's food, what's meals, and even though you're doing it because of marketing, that is what gives you the right to deduct it, because of that is the business purpose. But you have to follow within the rules of how much you can deduct, what, when, where, and you want to write on the invoice, on the receipt. Very helpful at the point of you get that receipt, who, what, when, why, where. When is on there? It's usually dated and time stamped. Where, it's usually got the business name on the receipt. You would maybe want to write on the receipt who and why. And that, because it's usually the marketing would be the business purpose, to be allowed for this. If you didn't have that, you probably wouldn't be allowed the deduction at all. Sorry if I sounded really short and curt. Yeah, we just, again, there are many ways to disguise the question as I want to deduct it 100%, and that's why these rules exist. And then there's a lot of gray area in this area also. So a lot of it's, just think it through, talk to your tax advisor. We can talk later with more nuanced questions. Moving on to the Secure Act. This has been around for a couple of years. I'm on page 3 of the handout. This was a bipartisan rule. It does not expire. The couple of big takeaways was, it used to be that after you turned 70 and a half, you couldn't put money into a retirement plan anymore, that you pretty much got capped out at 70 and a half. And you could now, as long as you're working, as long as you have earned income, you can still contribute to your retirement plan. Whether you're an employee with a 401k, an IRA, as long as you have earned income, you must be working. You can't just contribute. You can't retire and contribute. But if you have earned income, you can contribute to your retirement plan. The other side of that is when do you start taking money out? There used to be required, there's all the rules about required minimum distributions and how it's calculated are still generally the same. But when you take that first and when you need to start taking them changed. When in the year, it used to be in the year you turned 70 and a half, and there were a lot of strange nuanced rules about when you turn half to take that first deduction. That was very complicated. I'm glad they got rid of it. Now it's when you turn 72. Pretty much more straightforward. When you turn 72, you need to start taking required minimum distributions. There is some splitting of hairs that we're not going to get through today, go over today, but that's for the most part. When you retire, if you have a 401k plan through an employer, you have a traditional IRA, when you start taking your required minimum distributions, they start at 72 after you stop working. Or you can still be working, you got to take them, I believe. The stretch IRA, there was a concept before when if you had an IRA and you inherited an IRA, you could generally stretch it over a longer lifespan than the decedent would have had as the beneficiary. Generally, if you inherit an IRA, you need to take it out over 10 years, by 10 years. The rules are still a little vague. Do you need to take it out spread out evenly over 10 years? Do you need to take it out by the end of 10 years? We're still waiting for some guidance on all the nuances, but in general, if you inherit an IRA, it needs to be fully withdrawn by the end of 10 years. The general explanation of that. That's on the individual side. At the bottom of the page, we're not going to cover it, but there are some within the Secure Act. They had some rules put into place of assisting and credits to help open plans. Long story short, they're trying to encourage retirement savings. We're all reading the news about Social Security, the Social Security fund dwindling. They're trying to encourage people to save. They're trying to encourage employers to save for their employees, to open plans, and then they're also making it easier, to save a little bit longer. That's page 3. Page 4. This is the Inflation Reduction Act over the summer. That was more nuanced, was very nuanced, more towards climate change and green, quote unquote, green benefits, green tax benefits. It was not nearly as encompassing as what we just spoke about for all the rules for individuals and businesses regarding the Tax Cuts and Jobs Act. This was more targeted as trying to get the U.S. economy, U.S. individuals, U.S. businesses using renewable sources of resources and providing the benefits for that. Some of the tax benefits were set to, if they hadn't already expired, they were set to expire. So this extended things out. It's a 10-year plan. There are many, many credits out there, especially on the business side, whether you're burning, for cleaner coal, for nuclear, for various. That's not the scope of this course here. We're focusing more on what we're most likely to see as individuals and as small businesses. So starting right at the top, I'm not going to go through it all. Hopefully there's actually a decent summary to read to catch some of the nuances. But the residential clean energy credit, that's very simply, that is the 30%. It's been around for a long time. Now it's been set to slowly, they kept pushing it out and expiring and pushing it out. That is the 30% tax credit for individuals to put solar panels, geothermal. Now it's getting into battery technology, 30% credit for renewable energy at your home. I consider that to make the energy. Solar panels are going to produce electricity. Batteries, they may not make the energy, but it'll store the energy. That's where you're getting the 30% credit. That was all due to really start expiring. It was even last year and start ratcheting down. So this pushed the 30% out for 10 years. It changed some of the rules to make it a little bit harder to get the full credit because they're trying to, again, make sure that the items are doing what they're meant to do. And so that got pushed out. So there's the 30% credit to make energy. The next one is a credit for what we call the energy efficient home improvement. Those are for what it sounds like, improvements in your home. You're insulating, you're doing new windows, new doors. That credit was the one for a little while. It was a $500 credit for everything with a lifetime cap. For about a year or two, it went up to, I think, $1,500 that people took advantage of. That was about 10 years ago or so. And then it was back to the $500. And many people have not been able to take advantage of this one at all for years, because if you're a homeowner and you've taken the credit, the $500 lifetime, you've taken it. That was a lifetime cap of $500. And so what they did was they revamped it, they upped it a little bit, and instead of a lifetime credit, it's an annual credit. So really these are for improvements in your home. If you look at the first bullet, the $1,200 maximum credit for all types of home, that's an annual bit, that's annual. So you get $600 for any qualified energy property. That's things like insulation, et cetera, in your home. There's a different bucket for windows and doors, windows and skylights rather. And then $250 for doors. So the numbers aren't huge, but they're trying to spur it on a little bit. They're not going to, again, the IRS, the taxpayer is not going to pay for everybody else's skylights and everybody else's, but they're trying to help. That's what this is. Hopefully it helps the economy. Hopefully it helps the manufacturers. Hopefully the manufacturers start, making more of these. It is the idea, and that people will buy them and get some of the benefit. And it's, like I said, there's a $1,200 credit annual, so you can do some stuff in December and more in January when you make your purchases, so that you can, saddle it over 2 years and get a higher amount than you would if you did it all in 1 month, in 1 calendar year. And then there's also the last bullet talks about energy property like natural gas heat pumps, water heaters, etc. And that is a different credit from the $1,200. So it gets a little complicated with the different buckets. But the idea is the same as what we used to have. They just increased the buckets and they've made it annual limits rather than lifetime limits. The clean vehicle credit, that's the one we hear about in the news all the time regarding electric vehicles, getting a tax credit for buying a car, an electric vehicle. The old rules had lifetime limit maximum by manufacturer. When a manufacturer made their 200,000th vehicle, they would start phasing out. They did away with that limit, but they also put income and purchase price limits on these. They're trying to get these cars cheaper and to more people, is the idea. So if you look through the middle of my book, I'm not going to get into what qualifies and the car itself, but we're getting into if a taxpayer's adjusted gross income, that's what we spoke about before, all your income, not your deductions. If you're on a joint tax return, if your income exceeds $300,000, or 150 for a single, if you exceed that by $1, you're not eligible for this credit. So it's bringing down the income limits, and also the vehicle itself. A car can't exceed 55,000. If the purchase price of the vehicle is 55,000, the vehicle is not eligible for the credit. That's a car. And then for SUVs and pickup trucks, it's $80,000. Unlike earlier numbers, the numbers I just described are not adjusted for inflation. These are the numbers for the years of this. And there's no there's no phase out, no threshold. So if the vehicle's price is 55,001, there's zero credit available. I'll guarantee you'll never see that. It'll be priced accordingly. It's the manufacturer's retail price is what it goes by. And it also on the income limit. If your adjusted gross income is 300,001, married, filing, joint, you're not eligible for the credit. And this is based on your gross income, so you can't start taking some deductions to get down. This is based on gross income. But we'll see this. The idea is, like I said, they're trying to make the cars cheaper and more readily available for more people. And it's not only over a year or two. This is going to be good for 10 years. So the idea is to see more of these, not yet, but in 2, 3, 4, 5 years from now. And then with there's some rules. There's also you can sell your used the car that already received the credit in the past can now there's a used credit. But some of the rules I just described still apply. The income limits for the buyer are lower or cut in half, and the credit is only $4,000. And that's also much further down. Moving on to miscellaneous topics. This is all still income taxes. We already talked about the first section, the meals. I put it there a second time to kind of stand out. And we already discussed that. That's probably the most, I don't want to say the most controversial, but the most difficult with a lot of nuances of all these. That's why I kind of moved on before. That's your meals. Hot topic these days is cryptocurrency. We did the chamber. There was a seminar. If you go to the chamber's library, online, open to anybody. We have a 1-hour seminar. It was great. Had some good feedback. There's a 1-hour seminar of introduction to cryptocurrency. But for purposes of today, in a nutshell, it's just like buying an asset. You bought it at cost. You paid some price for it. When you sell it, you have income or loss. You have to report that. One thing, I don't want to get into the details and work with your financial planner. We can talk about it later. Cryptocurrency, this is the second bullet. We have what's called the wash sale rules do not currently apply to cryptocurrency. It has to be the currency side. If you own an investment in the entity, like stock or part of a mutual fund that owns a company that has cryptocurrency, that's having like a mutual fund or a stock, and all normal rules apply. But if you have an investment in cryptocurrency, it's not subject to the wash sale rules, meaning it's relative. A couple of years ago, everything was up. It didn't matter. The wash sale rule says you sell something today for a loss. You cannot deduct that loss if you buy the same asset within the next 30 days. Those rules do not apply. The same investment, I should say. It's not asset. Those rules do not apply to cryptocurrency because it's just the way the rules were written. The way they wrote the rules back in 2014 for cryptocurrency are still the same rules. Crypto is treated more as an asset as opposed to an investment from the IRS's perspective. So if you have a loss today, you can sell it. You get the loss. You have the loss, and you can immediately buy that same investment back anytime in the next 30 days and still be allowed to deduct that loss. There are loss limits. Let's move on to say when you take that loss, all the loss could offset other income on like things other. When I say other income, investment income, stocks, bonds, etc., gains on those. up to another $3,000. But this is the wash sale rule I'm talking about. You can immediately buy that and take that and have that loss available as opposed to being disallowed the loss completely. We could talk about that more. I just want to cover a couple quick things. We can go back to that. Another bullet. This was from last year's handout, identity theft measures. That's been rampant. It continues to be rampant. You'll see 2 website addresses on the handout. One is highly recommended for individuals. Go on the IRS website and create open up an account, an IRS website account. You can see if you're married filing joint, you both need to open these up. It's a little bit separate, it's a little bit cumbersome, but it's well worth it because you can see your payments. You can, with a lot of this got very popular with the IRS not getting checks. People mail their check and it didn't arrive. So this is a good way to see if they got your payments, your history, etc. Excuse me. And the second bullet is opening up a tax PTIN number. It will complement your social security number. Beware, that's highly recommended. You'll get a new number every year and you can't file your tax return without this other number. You would use your social security number and this 6-digit number. If the IRS receives a fraudulent tax return without this 6-digit number, or if you file and forget to include the 6-digit number, they will not process it. So if you do this, which I recommend, just beware of the fact that it's one more compliance hurdle of remembering to get that number, to use that number on your return, or provide that number to your paid preparer, so that way it can be processed. And that number will change every year, but it's designed. There's just been a lot of filings, fraudulent filings of other folks first to file getting refunds when it's not you, it's somebody else, and just gumming up the whole system, making it very difficult for you to clear your name through the IRS and getting your refund or getting your tax account cleared up. So this is just one extra hurdle to try to help people, and I recommend that. Student loan forgiveness, we're not going to get into that. It's the hot topic. It's in limbo right now. Will it happen? Will it not happen? The main thing to know about this is if you do have student loan and you qualify to be forgiven up to 2026, up until before 2026, that amount forgiven is not included in income. The regular tax rules, if you have debt forgiven, it's considered income because it's almost like getting money. You're not paying your debt. It's like you got money. So it's included in income. But these debt forgiveness rules up till 2026 is if you have forgiven debt, it's not additional income. So that's why I'm mentioning it today. Last 2 more, the 1099K reporting. This came out with earlier in the year. It's been out for a couple of years, really kicking in. If you do things through, if you're receiving money through PayPal, Venmo, any of these third parties, if you're receiving it as a friends and family, you're just, you're doing easy exchanges for whatever reasons. And I know PayPal has a term, friends and family. I don't know what the word would be for others. Those transactions are excluded. This is for, in PayPal's words, goods and services. For all the transactions using goods and services in PayPal or otherwise like that on other third-party transactions, if you have more than $600 in sales, they are going to provide you with a Form 1099-K. You get a 1099-K, the IRS gets a 1099-K. That number last year and earlier, first it was nothing. Last year was $20,000. The ceiling went way down. They feel the Congress felt when this was passed that there's a lot of money not being reported through these sales. It doesn't mean you also take the deduction. You would report it on your income tax return as self-employed. It would be your side, for example, side hustle money. We talked about it earlier. With that side hustle, you might have some meals to deduct. You might have some other items to deduct. So no one's saying this full amount is taxable, but you have to report it as self-employment income, and other hurdles, and just being more careful. If it's not goods and services, and it's friends and family transactions, be very careful of how things are being reported and how you're using these third-party payment systems, because the reporting is becoming onerous. Some in Congress are trying to punt this, put a delay on it, hold it up. Unless something changes fast, these are the rules going into 2022. So be on the lookout if you have these kind of sales for getting Form 1099-K. And last but not least, the paragraph above it are the inflation adjusted amounts. That's we're running out of time, but I'm going to keep going. Anyone who wants to stay on. On the tax planning side, the inflation adjusted amounts are jumping again, kind of like I talked about the tax brackets before. The 401k contributions are currently for 2022, the maximum is $20,500. That's been going up anywhere from sometimes 1,000, but usually goes up 500 a year, if at all. It's going from 20,005 to 22,005 as the ceiling for married filing joint. For everybody, for all individuals in a 401k plan. And if you're 50 and older, what they call the catch-up, the total is going from 27 to 30. So what I was trying to say, a married filing joint couple, if they both maximize, you're going to be allowed to contribute in 2023 between you 6,000 more. If you do that, that's also a big hit to your take-home pay. So like I always said, everything's always, cash is king. Consider that, but it's there if you have the money. I mean, I highly recommend maxing what you can. That's the easiest way to reduce your taxes. But like I said, but it costs money. Individuals have less and less opportunities to save taxes, and contributing to a retirement plan is the biggest vehicle. You can exclude up to $30,000 of income in 2023 if for someone that's 50 and older, if they maximize their contributions. And the paragraph above is the maximum IRA going from 6 to 6,500 and up to 7,500 if you're 50 and older. That kind of covers the handout, mixed in there with some planning. But in a nutshell, on the tax planning side, as an individual, it's really hard to save any money taxes without spending a lot of cash. I'm not trying to sound poo-poo about that, but the rule did that on purpose. It was part of trying to simplify things. As you can see, nothing's simple, but the idea was, but you can. One thing I didn't talk about with itemized deductions versus standard deduction, and it's getting harder and harder to do this because of the adjusted for inflation numbers. The standard deduction for Maryland for married filing joint is $4,500, and Maryland has a rule: if you itemize for federal, you must itemize for Maryland. If you take the standard deduction for federal, you must take the standard deduction for Maryland. When these rules on the federal side first came out, there was some talk. Governor Hogan's office tried to decouple, for lack of an English. They tried to break that up. They tried to say you could itemize for federal. You could take the standard deduction for federal and still itemize for Maryland. They didn't allow that. It didn't go through. The reason why that's important is in 2023, we said the itemized deduction ceiling is the limit. Well, the standard deduction, is $27,700 for the IRS for federal. So if you have a standard deduction of $27,700, your Maryland standard deduction is $4,500. That difference is Maryland taxed, not deducted. That's not an increase in Maryland. I mean, it's always been this, but there's a difference there. So what I'm getting at is, as far as tax planning, sometimes there's a sweet spot where if you're allowed $27,700 for federal, maybe you don't take the full 27. You itemize. You have to have these deductions. You itemize at say 25, and even though you're allowed more to take the standard deduction, you choose not to. You stop at 25. You're losing some federal deduction, but now you're itemizing for Maryland. So instead of the 4,500 standard, you're taking a much harder. It gets complicated because there are also rules because your income taxes are not deductible in Maryland, and it gets complicated. But I just want to throw out that idea of that's one of the bullets is what I'm calling forcing the itemized deduction for federal, losing some federal benefit. It's getting harder to do that because as the federal standard deduction is increasing, that spread is increasing. So it's getting more and more likely or less likely that you're going to do the forcing, and more likely that the benefit is still greater because the Maryland rate is only about 8-9% versus the federal rate is probably in the 20s. So you're still going to get a better overall rate. It's just a sweet spot. If you do your own income tax return, if you use TurboTax or something, there's an optimize button to use. If you have a paid preparer, hopefully they're optimizing. I know we do. We're looking at this. And if you're doing it on your own, just know that it's out there. Also, something called bunching, which is also getting harder, is instead of spreading out all your charitable contributions, and this has to be miserable for the entities, for the charitable contribution entities, for the donees. We call it bunching. Instead of giving all your donations, you're doing $100 a month, every month, some kind of auto pay. So that's $1,200 in year one, $1,200 in year two. Maybe you do all in year one, $2,400. That'll increase the amount you can deduct as an itemized deduction for federal, and then you do zero in year two. So you double up 1 year, and you make 0 in year 2. Or maybe you do all in January, or rather all in December. Double up what you would normally do in December, do none the following year, and then more the following January. You got to track, it gets complicated. But it's playing some games to try to figure out what's the best situation in order to capture the itemized federal deduction, the itemized federal deduction. And then once you get the hang of it all, remember, it's going back to the old rules in 2026. So that's on the individual side. Give me one more minute. I know Kim, if you got to hang up, I know hang up. Just bear with me one more minute. On the business side, again, same thing. It costs you money to save money. We talked about meals. That's what, just go back, look at your receipts. If you took people out in 2022, it's 100%. Those meals, not 50%. Travel. Everything has to have a business purpose. If you have a business purpose, if your commuting is not deductible, the drive from your house, from home to work and back. But if you're on the road a lot, if you're traveling to see people, this has gone down a lot because of COVID, but it's starting to come back. So I'm reminding people, track your business miles. They're deductible. Home office, the rules for your home office are very specific. I'm not going to get into the rules about it, but if you work from home, if you have nowhere else to work, if you have an office at an office and they're letting you work remotely, but you still have an office, then you technically don't have a home office. Your home office is when you have nowhere else to work and you work from home. The home office also must be a unique, you can't share the room with the infant in a crib. It can't be the kitchen table. It can't be the family room. You need to have a unique space carved out as your home office. The reason why that's becoming more popular, it's not a huge deduction, but it's out there. Everything adds up. It's limited to the percentage of your square feet of your office to your home. But if you have a mortgage and you have mortgage interest that you're not otherwise able to deduct because of the large standard deduction, if you have a mortgage and if you have real estate taxes, those go into the formula to take the home office deduction. Again, it's not a huge amount in the scheme of it all, but every little bit adds up. If you need a new computer, if you're working, whether you work from home, it's a business deduction. Doesn't matter where you work, but it has to be a bona fide business. And me as an employee getting a W-2, I can't just buy a computer and expense it. That's my employer's job. But if you're self-employed and you need new office equipment, you need new furniture, you can buy that. We talked about some deductions before, but revisit where you're at technology-wise. If you need a new computer, now would be the time to potentially do it. Don't just buy one because you can deduct it. Cash is king. Don't buy stuff just because you can deduct it. But if you need it, you get those deductions. And also don't forget your phone. I would never, if you have an iPhone or an Android that you're using for work, if it's 100% work, it's 100% deductible. If it's something that's split between home, personal, it's very hard. Most people don't have 2 iPhones anymore. The old days with flip phones. Some people had a flip phone for work, but they had something else. It's very hard to rationalize and justify a 100% deduction for that phone when so much of it is also being used for personal, but you can allocate it. Be reasonable, be fair, but don't do 0 if you're using a lot of it for work, if you're self-employed. That generally covers what I plan to cover today. Sorry for going a little over. Thank you. Thank you for being here. Thank you for doing this. My contact information is on the top of the sheet. I'm not hanging up. I'm still around if anyone wants to hang around a bit for questions. But if you need to go and you need to leave, the header of my handout has the office number at Bormel, Grice Huyett. And reach out, ask for me. It's the main office number, ask for Barry, and I'm happy to try to clear some of this up. So thank you very much.
Great, thank you, Barry. And thank you to all of you online and here in the office that were able to join us today. And we hope you'll tune in to future webinars and other events. We're planning a lot of great stuff for January and on into 2023. So you can find our schedule at the website, which is centralmarylandchamber.org. But thank you again to Barry and Bormel, Grice Huyett for sharing all of this great information with us today. And I encourage our guests to reach out to Barry to schedule a one-on-one if you have additional questions, or we can hang on here for a little while longer if you have questions. But happy holidays, and we hope to see you soon.
You need my